Guys, have you heard that Vanguard Group just fired a huge salvo by cutting fees for their funds and ETFs? In this video, let's understand how this affects investors like you and me and other fund managers. So, Vanguard announced their largest ever fee reduction a few days ago. This move will reduce their average asset-weighted expense ratio to 0.07% for their $10 trillion under the management. In comparison, the funds industry average expense ratio stands at 0.44%. This move is a big shock to companies like BlackRock. The stock price of BlackRock is down almost 10% since the announcement, and it's understandable why. BlackRock and similar fund managers stand to lose hundreds of millions in revenues. Vanguard's press release says that effective February 1st, the fee reductions affects 168 share classes across 87 funds. This will save investors more than $350 million in 2025 alone. Here's a sample of funds whose fees will get reduced. For some funds, it's 1 basis point. For others, it's more than that. On a percentage basis, this reduction ranges between 10 and 20% across the board. You can check out this Vanguard page yourself, I linked in the description. Guys, this is huge and a great news for investors like you and me. But how on earth Vanguard is able to reduce these fees to such rock bottom levels? Since its founding in 1975, Vanguard was able to reduce its fees 2,000 times. Well, for that we should thank John Bogle. He pioneered such a Vanguard corporate structure that benefits its investors directly. Okay, so you probably know a typical corporate structure. Usually, shareholders of a given corporation are separate from its customers. For instance, let's take BlackRock. Its customers are investors, like retail investors who put their money into their funds, like iShares, for instance. But the owners of BlackRock stock are someone else, and among them are other large financial institutions. So BlackRock's goal is to maximize benefit and profits for its shareholders, not its customers. With Vanguard, things are different. Investors in Vanguard funds are the de facto owners of Vanguard Group. For instance, Vanguard's board of directors gets elected by Vanguard fund investors. Fund managers like Vanguard and BlackRock earn fees by charging certain expense ratios. For instance, the VOO fund charges 0.03% on its asset under management of roughly $620 billion. This roughly translates into $186 million of revenues for Vanguard just for VOO. Of course, Vanguard has operating costs to cover. Among them are tech, offices, and salaries to its employees. But once these costs are covered, all the remaining profits, they go back to Vanguard's funds. That's right, they benefit investors into Vanguard's funds. And over time, Vanguard's operations have become so efficient and scaled up, and this is exactly what allowed them to make these cost reductions possible. So we see that Vanguard does not face the same pressure to maintain its margins like BlackRock or Invesco do. John Bogle did such a tremendous public service by setting up Vanguard this way. I just cannot thank him enough. As we saw, this will put big pressure on Vanguard's rivals. According to Bloomberg, anywhere from 30 to 50% of 3,900 US-listed ETFs are operating at a loss. A typical ETF has about 200 to 350,000 in fixed costs, such as salaries, plus about 0.075% in variable costs to cover. So we see that Vanguard's rock-bottom expense ratios are driving many issuers out of business. BlackRock holds the largest market share among fund managers at 11.5%, but Vanguard is the second close with about 9% market share. So it becomes pretty obvious for many fund managers that it is impossible to compete with Vanguard on fees alone. For this reason, we will see an increasing differentiation among fund managers. They will likely go after higher priced products in niche categories. For instance, among them could be crypto, alternatives, or covered call funds. Actually, thanks to this exact trend, we saw a slight uptick in average expense ratio for newly issued funds like ETFs in 2024. It's not a secret that costs matter to investors, especially for index funds that track things like S&P 500 or Russell indices. I often say in my videos that returns vary, but costs are always subtracted. According to Vanguard, its low fees matter a lot for certain fund categories. For instance, 91 of its active bond funds and 100% of its money market funds have outperformed its peers' average returns. We see that Vanguard's consistent cost cutting has created a loyal base among its investors. The thing is that even these small cost reductions compound into tangible dollars over time. So instead of going to someone else's pocket, Vanguard takes this money and gives it back to its investors. And this is something to celebrate. If you enjoyed this video, give it a like. I create weekly actionable content on personal finance, investing, and more. So be sure to subscribe, and I will see you next time. All the best!